Imagine checking your phone one morning and realizing you own a microscopic slice of Apple, Microsoft, or a company you've never even visited. Not because you're rich, not because you're on Wall Street, but because you tapped a screen while waiting for coffee. That's the stock market in 2026. It feels casual, frictionless, almost boring. And yet it quietly decides who builds the future and who gets left holding risk when the excitement fades. Here's the uncomfortable truth. Most people investing today don't actually know what they own. They know the app, they know the ticker symbol, they know the green arrow feels good. But the system underneath? That's where things get interesting. And in 2026, it matters more than ever. Because markets are faster, information is louder, algorithms trade in milliseconds, and beginner investors now move billions with a swipe. So let's slow this down. No jargon, no MBA lecture, just how the stock market actually works and why it doesn't behave the way social media says it should. At its core, a stock is simple. A company needs money to grow. Maybe it wants to build factories, hire engineers, expand into Asia, or survive a bad year. Instead of borrowing all that money from a bank, it can sell pieces of itself, shares. If a company divides itself into 1 million shares and you buy one, you own 1/1,000,000th of that business. That's it. No mystery. But here's where the story shifts. Companies don't just sell shares to anyone at any time. First, they go public, an IPO, initial public offering. This is when a private company opens the door and says, you can now own part of us. Investment banks help set a starting price, big institutions get early access, excitement builds, headlines explode. Then the stock starts trading on an exchange like the New York Stock Exchange or NASDAQ. From that moment on, most trading isn't between you and the company, it's between investors. You're not giving the company money when you buy shares from someone else. You're buying ownership from another owner. That distinction matters because once a company is public, its stock price mostly reflects what people think will happen next, not what is happening now. The stock market is a prediction machine, and predictions are emotional. Let's say a company earns $1 billion this year. If investors think it will earn $2 billion next year, the stock can rise today. If investors think growth will slow, the stock can fall, even if profits are record high. So prices move on expectations, not facts. That's why in 2026, you'll see something strange. A company announces good earnings, the stock drops. Why? Because expectations were even higher. The market isn't grading the past, it's betting on the future. Now, here's the part beginners often miss. When you buy a stock, you're buying two things: ownership and risk. The company could grow, it could stagnate, it could disappear. If it grows, your shares become more valuable. If it struggles, your shares shrink. If it fails completely, equity holders get paid last. After employees, after bondholders, after banks. Last. Ownership sounds powerful, but in bankruptcy, it's fragile. Now, zoom out. Why does the stock market even exist? Because it solves a massive economic problem. It connects people with money to people with ideas. You might have $500, a company might need $5 billion. The market pools millions of small investors together, and suddenly skyscrapers get built, AI systems get funded, new drugs get tested. It's organized risk sharing. That's the ideal version. But 2026 isn't just fundamentals, it's also hype. Zero commission trading, viral stock trends, AI-driven recommendations, influencers explaining option strategies in 30 seconds. The barrier to entry is gone, which sounds democratic, and it is, but lower barriers also mean faster mistakes. Because here's the math most beginners don't calculate. When you buy a stock at a high valuation, you're paying for years of expected growth up front. Let's simplify. If a company earns $1 per share and trades for $20, that's a price-to-earnings ratio of 20.
You're paying $20 for every $1 of annual profit. Why would anyone do that? Because they believe profits will rise. If profits double, the price makes sense. If they don't, the price compresses. And compression is painful. In the 2020s, we saw waves of this. Tech surges, AI booms, green energy hype, sudden crashes. Not because companies were fake, but because expectations outran reality. The stock market is not a scoreboard, it's an auction. Prices move to wherever the most aggressive buyer and seller agree every second. And in 2026, many of those buyers aren't human. Algorithms scan headlines, react to keywords, trade in milliseconds, long before retail investors even finish reading the news. So where does that leave beginners? In a system that looks simple on the surface. Buy low, sell high, but underneath it's layers. Institutions managing pension funds, hedge funds leveraging positions, market makers providing liquidity, high-frequency traders skimming tiny spreads at enormous volume. You're not alone in the market. You're participating in a global arena. Now let's address dividends. Some companies share profits directly. If you own shares, you may receive cash payments. That's real money, not just price appreciation. In slower markets, dividends matter more than flashy growth. Quiet returns, compounding over time. Which brings us to the most overlooked force in investing: time. If a stock grows at average of 8% annually, it doesn't double in 8 years. Compounding changes the curve. Growth builds on growth. But here's the irony. Most beginners enter during excitement, when prices are already elevated. Fear keeps them out during downturns, when future returns are mathematically more attractive. The stock market rewards patience, but it emotionally pressures impatience. That tension never disappears. Now, zoom out further. The stock market isn't the economy. They overlap, but they're not identical. Markets can rise during recessions. They can fall during strong GDP growth. Because markets care about the future path, not the present headline. So when you hear, the economy is strong, why are stocks down? Remember, investors are already looking 6 to 12 months ahead. Always. In 2026, there's another layer: passive investing. Index funds now hold massive portions of the market. Instead of picking individual companies, investors buy the entire index, the S&P 500, total market funds. This shifts dynamics. Money flows automatically into the largest companies. The bigger they get, the more money flows in. It's efficient, but it also concentrates power. A handful of mega-cap companies now influence entire indexes. So when they move, the whole market moves. That's structural, not emotional. And structure shapes outcomes more than headlines do. So what does this mean for someone starting today? It means the stock market is not a casino, but it can feel like one if you don't understand the rules. It's not evil, but it's not fair in the way beginners assume. It rewards capital. It rewards time. It rewards discipline. It punishes leverage. It punishes panic. It punishes certainty. Because certainty is usually wrong. The deeper truth is, the stock market is a mirror. It reflects human optimism, human fear, human greed, human doubt, all priced in real time. So when someone says the market is crazy, what they often mean is human expectations are unstable, and they always have been. The question isn't whether the market works. It does. Trillions of dollars move efficiently every day. Companies get funded, investors get liquidity, retirements get built. The better question is, do you understand the game you're stepping into? Because owning a share means owning uncertainty. And in 2026, uncertainty travels faster than ever. The system isn't broken, but it's louder, faster, more crowded. So the final question isn't, can you make money? It's this: when prices swing, headlines scream, and predictions clash, will you know whether you're investing or just reacting?